All right, let's dive into something that might sound a little, dry on the surface, but is actually the secret engine that powers pretty much every growing business out there. Trade payables. Seriously, this is the key that can unlock growth, especially when you're just getting started. Let's get into it. I mean, this is the million-dollar question, isn't it? You've got this brilliant idea. Let's say you want to start a cool new sneaker company. We'll call it Sneakers for All, but you're working with little to no starting cash. How do you possibly get from that idea to actually selling stuff? And this brings us right to the first major hurdle, what I like to call the growth dilemma. It's a classic chicken and egg problem that can literally stop a great idea in its tracks before it even gets a chance.
Here's the heart of it. To sell your awesome sneakers, you need to have sneakers in stock, right? But to buy those sneakers from your manufacturer, you need cash. And where do you get the cash? From selling the sneakers. It's this incredibly frustrating loop. So, how do you break out?
Well, the answer lies in one of the oldest, most powerful tools in the history of business, credit. And this is where the entire game changes for our little sneaker company.
It's an idea you already know, but for a business, it's a lifesaver. Buy now, pay later. Your supplier agrees to give you the inventory you need today, with the understanding that you'll pay them for it later, maybe in 30, 60, or even 90 days. Just like that, that single agreement shatters the cash loop. You can actually start making sales.
And that promise, that official IOU that you give to your supplier, it has a formal name, a trade payable. Now, yeah, it's a liability, it's a debt on your books, but here's the thing, it's what we call a good liability, because you used it to get an asset, your inventory, that's going to generate income.
Okay, let's see how this actually works with the fundamental accounting equation. So, you buy 900 rands worth of sneaker laces on credit. Two things happen instantly. Your assets go up by 900 because you now have that inventory, and at the same time, your liabilities go up by 900 because you've created that trade payable, the IOU. See that? The equation stays perfectly in balance. Pretty cool, huh?
So, buying on credit is awesome. Your business is finally moving. But this solution creates a brand new challenge, and it's a tricky one. You've got to manage all those IOUs.
Suddenly, you don't have just one IOU. You've got one with shoes for you for the sneakers, another one with plethora of fabric for the laces, and each one has a different amount and a different due date. If you don't track this stuff perfectly, you could seriously damage your reputation with suppliers, or worse, have a cash crisis pop up out of nowhere.
To solve this, accountants use a really clever two-part system. First, there's a general ledger. Think of this like the dashboard in your car. It just shows the grand total you owe to everyone all rolled up into one big number. Then you have the subsidiary ledger. This is where the magic happens. It's like a collection of super detailed to-do lists with a separate page for each supplier, tracking every single invoice and payment.
And here is the golden rule. These two books have to agree always. The grand total in the general ledger must equal the sum of all the individual accounts in the subsidiary ledger. If it doesn't, that's a red flag. You know you've got a problem somewhere in your records.
Which brings us to the most critical part of this whole thing. What on earth do you do when your records say one thing, but your supplier's bill says something completely different?
This is the exact scenario that gives business owners nightmares. You open that monthly statement from your main supplier, Shoes for You, and they say you owe them over $25,000. But your records, which you've kept so carefully, say you only owe them a bit over $16,000. That is a massive difference. Who's right? How do you even begin to fix this?
Okay, this is not a time to panic. It is, however, time to put on your detective hat because we are about to solve a financial mystery. This whole investigation process actually has a formal name. It's called a creditor reconciliation. It's just a systematic way to compare your records against their statement to find the exact source of the problem.
It really breaks down into 4 simple steps. First, you compare. You go line by line matching every invoice and payment. Second, you identify anything and everything that doesn't match up. Third, you adjust. If you find an error on your side, like a typo, it happens, you correct your books. And finally, you reconcile by creating a little report that lists and explains any leftover differences. This proves that once you account for everything, the balances are actually in sync.
And a lot of the time, the reasons for the mismatch are pretty simple. The number one cause is just a timing difference. You sent a payment on the 29th, but they printed their statement on the 25th. Of course it doesn't match. Other times, it's a simple error. Maybe you typed 353 instead of 335,
Or maybe, and this happens more than you'd think, they accidentally billed you for someone else's order. The reconciliation is what finds these things.
So why go through all this trouble? I mean, it sounds like a lot of work, right? Well, it's because getting this right goes way beyond just paying one bill correctly. This is about the fundamental health of your entire business.
First, it ensures your financial reports are accurate, which you absolutely need to make smart decisions and get loans. Second, it's a huge deal for cash flow management. You can't plan for the future if you don't know precisely what you owe and when. And maybe most important of all, it builds trust. When your suppliers see you as organized, reliable, and honest, they become true partners in your growth.
So in the end, mastering trade payables and this whole reconciliation process isn't just about accounting. It's about building a solid foundation for growth. Knowing exactly what you owe is the first, non-negotiable step. The next big step, of course, is knowing if you have the cash to actually pay it. But that's a story for another time.